Good afternoon, everyone. Thank you so much for joining us today. We have a great 60 minutes lined up for you with very timely information. So a few things before we get started. A reminder, this is being recorded and it will be made available on community.franchise.org along with the PowerPoint deck here. If you have any questions for Eric and Fred today, please put them in the questions box and Eric will be reviewing them and we'll get to them at the end. All right, so today is brought to you by our great friends at Benetrends Financial. And the topic is SBA lending for 150K and under, what you need to know and debunking the common myths. With Benetrends, we have Eric Schechterman, CDO for Benetrends with us today. Eric, I'm gonna kick it over to you now to get us into the content.
All right, thank you, Caitlin. And of course, thank you to the IFA. Always so important to support the IFA and what they do for our whole industry. And Benetrends is so lucky to be working with the IFA on making sure all of their members are educated on what's going out there in franchising and of course in the lending space. As Caitlin mentioned, if you have any questions, please feel free to tap them into the question box. We'll address them at the end. And I always like to check just to be safe. If somebody could type into the chat box that they hear us okay, that there's no audio or visual problems, please go ahead and at least give me some confirmation there as we start to go through the content. But as Caitlin mentioned, I am very fortunate to be joined by Fred Crispen today. Fred is the Senior Vice President of United Midwest Savings Bank. And for any of those on the line that have worked with clients in the last many years, that have had clients pursuing the $150,000 loan size and under, you probably have heard the name Fred Crispen or the name United Midwest Savings Bank. They are pretty much the primary lender that has an appetite for that loan size and under, specifically in the franchise industry. So Fred, thank you so much for joining us today.
My pleasure. Enjoy being here.
So Fred, before we get started, not your first rodeo in SBA lending or in the franchise space. For the listeners that don't get to be exposed to you on a consistent basis like a lot of funding partners do within the country, you mind just giving us a quick background and snapshot of your career in the small business lending space and even a smaller silo of franchising in itself?
Sure. I started in the SBA lending back in 1987 and originally in the larger loan market. In 2003, we were working for a non-bank lender out of New York. And we needed to get into a small loan market to help balance out our portfolio somewhat. And I was asked to check into making small loans. And we got involved with the SBA Community Express program back in those days, back in 2003, and kind of fell in love with a small ticket item and have been involved with that ever since. We've been with a couple of different banks over the years. We've been at United Midwest now about 4.5 years and thoroughly enjoying it. But once again, concentrating on small loans, $20,000 to $150,000 under the SBA 7A loan program.
Thank you for that background, and we're definitely very lucky to have you join us today. And it's great what you talked about already because it's going to be a lot of the topics that we cover today. Everyone, we're almost 20 months into COVID. You've been on more than enough webcams and screen shares and Zooms and seen probably more than enough slides to fill 10 lifetimes. So really not going to be too slide heavy. It's going to be more conversation driven. We are going to try to understand a little bit better what are the different programs, what does a bank look for specifically, even from Fred's experience on this loan size, what challenges are the lenders facing, what is it that they're looking for? What makes a brand attractive? What makes a candidate attractive? What's the best marriage of those two? What are the brands that really use this program with the lower startup costs? How do they get more noticed by the banks? What are some things that they can do to make their concept, for lack of better words, more fundable? Timelines is obviously a big topic and very volatile in our space, and people understanding what is a realistic timeline. Also, we have a lot of emerging franchise brands, brands that have less than 50 locations open that are always being told, well, banks don't have an appetite for X, Y, and Z. So talking about that versus established brands, And then again, going into what are some speed bumps, but more importantly, just making sure people have accurate information. And rather than hearing it from a third party like a Benetrends or any of the other funding companies that a lot of franchise brands and franchise consultants work with, I wanted to bring on one of the top lenders in the country to talk about this topic. And as I mentioned, Fred talked about a couple things. I think he said the word Community Express, he said 7A. My fascination with the 150 and under loan is the different names that it's taken on in recent years. In any given week, I get asked, Eric, I'm really interested in the low doc loan, or I'm really interested in the fast track loan, or in the express loan, or I don't want a 7A loan. I want the 150 and under, which is a 7A loan anyway. So obviously we're trying to keep it very focused on the 150 and under loan size. And Fred, what we hear a lot is, if I say the two most common, it's that comment right there. I hear there's a 7A loan, Fred, but I want an express loan for the 150 and under. Can you educate me and the audience, at least specifically on what you all do, at least at United Midwest, but even more collectively, a 150K and under loan? What is it really?
Well, the ones that we do are all under the SBA 7A, what is now the small loan program. We started out doing these loans. We started out, our maximum loan amount back in 2003 was like 25,000, and then we bumped that up to 50,000, and then it kind of grew from there. That Community Express program was a pilot program that SBA had installed. And in 2010, 11, somewhere in that time frame, SBA did away with that program. And so we didn't have that platform that would allow us to do quick, down and dirty, easy credit scored loan programs for about a year. And my son and I, Terry, who runs the small loan program with me, we worked with Washington to develop a new small loan program to replace Community Express, and it morphed into what is now the SBA 7A small loan program. Because we called it an express program back in the old Community Express days, everybody kind of took that title with it, and it's not a true SBA express loan. A true SBA express loan only carries a 50% loan guarantee, and the lender can use their own documents, their own forms, and that sort of thing. The 7A program under normal times carries an 85% loan guarantee for the lender, and requires we can credit score, but there's a lot of other documentation that have to go along with it. So that's kind of where that express came from. What we do, everybody still calls it an express loan because it's faster in process, so to speak.
Yeah, and that's what we run into a lot. We want the express loan, and
Right.
getting that middle spot of, well, does it even matter for me to educate them? Like, hey, it's 150 and under. But so is it safe to say that pretty much most of the loans that are being done within the franchise industry for, say, $150,000 and under, technically are 7A loans, but have adopted this name of express, but it's not really, in theory, being done as an express loan?
That's correct, especially from our standpoint. Now, there may be some lenders out there that are doing true express loans. Some of the larger banks, especially, they do them up under their credit card operations, I believe, and they would be a true express loan with only a 50% guarantee. But now we're a small bank. Everything we do, we're looking for that maximum guarantee. Right now today, it's a 90%. So, but that will end the end of this month.
Yeah, and just so everyone knows, when Fred talks about the guarantee, that is not to the borrower. There's a lot of confusion sometimes about these guarantees, and the borrower's like, hey, this thing's guaranteed. I'm like, yeah, for the lender. Yes. And the idea is guaranteeing it for the lender is a bank like Fred can look at an opportunity and say, we feel good about this loan, but we feel even better because we have some guarantee on the back end from the government through the SBA program to continue to incentivize us to put money out there in small business America. So that is a guarantee should there be a default on that loan, and provided that they have a good lending decision base. And Fred, I don't know if you want to touch base on like what that guarantee actually is to the borrower.
Yeah, basically for the borrower, the SBA in essence becomes their co-borrower or co-signer, if you will, in that the SBA guarantees the lender that if the lender does their job and closes that loan in conformance with the SBA's SOP and follows all the guidelines, then if that loan goes into default, they'll pay us typically 85 cents on the dollar. 15 cents on the dollar is our capital at risk, and that's provided we close within the SBA guidelines. If we mess something up in that file, then SBA can either impair that guarantee down to a lower amount or deny it altogether. So it's imperative from our standpoint, every deal we do, we're trying to make sure we met the guidelines that SBA calls for so that we can protect that guarantee in the case of a default.
Great. Now, staying with what is it really, we've established what it is, and I think everyone should stop worrying about so much, at least in my industry and the partners that we work with, so much of the name. Like, hey, you're going to get an SBA loan and worry about the loan size, whether it's 7A, Express, whatever. But some things that have changed a lot, like if I were to go back a few years ago and somebody said a 150 and under loan, it was, hey, this is great. 10% down, they're going to fund 90%, and it's this, and no collateral is required. I know that every borrower is different, but if you were to explain to somebody what the traditional terms and conditions that are being done on the 150 and under loan size is, from collateral, from equity injection, loan size, interest rates, could he kind of give us a 30,000-foot overview there?
Absolutely. SBA says that any loan 25,000 and below, we don't have to take collateral. It's basically their personal signature and go from there. Any loan in excess of 25,000, 26,000 on up to 150, SBA says that I have to take a lien on the business assets, but that's it. I don't have to take a lien on their personal residence, their firstborn child, or anything else. So that's the way we operate the program. We take a lien on the business assets on these small loans up to $150,000.
Yeah, and I think that's one of the big.
We set them up as working capital, 10-year loans, fully amortizing, no balloons, no call options. Loans from 20,000 to 50,000 are priced at prime plus 3.25%, which would make their rate today 6.5%. Loans from 51,000 up to 150 are priced at prime plus 2.75%, which would make their interest rate today 6%. They're all adjustable rate loans, adjusting calendar quarterly based on Wall Street Journal prime plus the spread.
Okay, great. And how about as far as, I'm going to go back to the collateral and some of the interest rates, but how about as far as equity injection from the borrower versus the loan value? Is there a firm number? Does it vary? I've heard as little as 10%, but then it's, well, how many actually only ask for 10%? Is it more of like the 20 to 30%? How much is a borrower being asked to inject of that total project costs?
SBA says the borrower has to inject a minimum of 10% of the total project cost. And it's a weird way to get to that, but a $150,000 loan basically would indicate that you've got a borrower with a total project cost of at least $166,600, and we're putting in 150. The borrower's putting in 16,666. Basically, is the way it works. Now, if you may have a franchise that's going to require a larger amount of a total project cost, let's say the total project cost is $200,000, then the borrower's putting in 50 and we're loaning 150. But the minimum is 10% on any startup.
Now, while that's the minimum, would you say it's probably more consistent that it's usually more that 20+% that a bank is typically at least looking for the borrower to put in, or is it literally client by client basis?
Now, from our standpoint, if they can make it work with a $150,000 loan and putting in the minimum 16,666, then we're comfortable with that.
Okay, great. Now, I know one thing, and I'm sure we have a lot of interested people in my next question, is when loans are a little, and total projects are a little bit larger, usually the franchise fee that a client might pay out of pocket will usually almost satisfy or at least be a chunk of that borrower's equity injection. So to your point, if I'm buying a $300,000 total project and my equity injection needed to be $75,000, I paid a $50,000 franchise fee. That's part of it. When we have some of these brands where their total investment is under $150,000, the bank just looks at the total project cost. They don't care if the project is franchise fee, working capital, whatever. So you run into scenarios where what the bank is asking from the borrower is only $20,000, but you have the franchisor that's asking for a franchise fee of $50,000, and they typically want that client to pay that up front before they get done with the loan. But the bank's telling them, well, you can include a part of those funds in the loan. I'm sure you've seen that scenario, and I know we probably have a lot of listeners that are saying, yeah, we run into that a lot. And franchisors don't typically love waiting till the loan is closed to get the balance of their franchise fee. Can you talk through that a little bit and how you've seen some of that works? Or the common question, if you could also touch on, is, well, Eric, I'll just pay that out of pocket, and then once I get the loan, I'll reimburse myself back what I didn't have to inject. And I say, whoa, no. But you're probably the better one to answer those topics.
Yeah, the bulk of the loans we're funding right now, we're funding right around 10 million a month, with an average loan size of probably around 140,000. But the bulk of those, the franchisor is taking a deposit up front, and they're creating a note receivable or an accounts receivable. There's been a big problem here recently with note receivables back to franchisors. They have to be voided out because of a quirk in the SBA regs. Hopefully that'll get fixed sometime in the next revision of the SOP. But right now today, those notes have to be voided, and we can pay an accounts receivable, but we can't pay off a note receivable. As far as the borrower paying it up front and reimbursing himself, no. SBA says once you put that money into the business, you can't turn around and pay yourself back. That remains in as equity. Once equity goes in, it's got to stay in.
So to play that scenario out, I'm buying a business for $150,000. I paid a $50,000 franchise fee. My loan size that I'm requesting is now $100,000. It's not going to be, well, I would have only needed to put in 20 or 30, and now I'm going to request this and pay myself back. So people have to be very cognizant of that.
Correct. You can't pay yourself back. We can make a $150,000 working capital, which would include paying that franchise fee, which we would break out in our SBA documents and pay that directly to the franchisor in a wire transfer. But outside of that, the rest of it would be general working capital. Unless you had some major equipment that you were buying, then that we would file a purchase money UCC on that major piece of equipment. Anything considered major would be anything worth $5,000 or more at the time of purchase.
Okay, great. So before we move on to anything else, and I know we were going to save some of the questions to the end, but I think when we get in on one specific topic and there seems to be a number of questions around, I want to address it. And obviously a big reason that a lot of franchisors and consultants and everyone in our industry that are working with loan sizes up to this amount on project costs, this has been a very popular program because it's being told small percentage down, no collateral. And as you talked about, it's not no collateral, it's that we're not required to take the personal collateral.
That's correct.
Some of the questions that we're getting about that is some of these franchise brands have in their agreement that the franchisor has the right to certain business assets within their franchise agreement should there be a default within the franchise or a violation of the franchise agreement. Or what about some of these franchise brands where, you know, hey, Fred, I'm starting a home-based service business. There's really not a ton of business assets. How would that work within the program? What have you seen there?
Yeah, I mean, we love the service-based businesses, and most of what we do are service-based businesses. And in a lot of cases, there are really no assets to be taken, and we're fine with that. because we've learned over the years that if you properly capitalize that business and make sure the borrower's got enough money to get it ramped up, get through that ramp up period, then they can be successful. They can generate sufficient income to pay us back. So yeah, our program is based on the premise that there's probably not any collateral there to go get if we have to go into liquidation.
Okay, great. The other thing that you had mentioned about how this loan is typically structured, sort of like a working capital loan, and this has become more popular recently. I know this wasn't always an issue within the program before. There weren't always a lot of brick and mortar opportunities that could be built for $150,000 and under. But now we're seeing some concepts at smaller square footage, TI coming back, certain things like that. What if my total project is 150 and under, but it is brick and mortar? How does that work as far as what I can use the loan for and what I can't?
I'm going to tell you to go to find another lender, your local bank, because it would just, at the end of the day, the borrower would be so upset with us by the time we put in appraisal fees, EPA phase ones, title insurance, and everything else we'd have to get involved in that deal. The outside cost would be more than what they would be comfortable with. So we're not a good fit for real estate deals. Our small loan program is built for the guy that's either operating from home or leasing space from a third-party independent individual.
So I can't use it primarily really for something where I'm building out brick and mortar, or it's really not geared for that. But what I can use the loan proceeds for, you talked about working capital. What sort of falls within there? Is that owner's salary? Is that manager's salary? Or is it just marketing and this and that? Can you kind of give me an idea of some of the common usages?
All of the above. Owner's salary. And one of the things we make a borrower do in their projections for us is to show us a salary sufficient for him to keep his debt to income ratios in line. In other words, he's still got to pay his home mortgage. He's still got to pay his car payments. He's still got to buy food, yada, yada, yada. So how much does it take him to run his household? That needs to be built into that pro forma, and we want to make sure he's paying himself enough to keep all of his credit in good shape. But in addition to that, employees, marketing, any kind of other general working capital expenditures, rent, general overhead that needs to be paid for, we need to account for that and make sure we've got enough built into this loan to take care of it.
Great. And being that most of, obviously the members of the IFA are franchisor members, I think one area I just maybe want to hammer home is for any of those franchisors that already do this or might not. If they have a candidate that's pursuing a loan for this size, and that candidate, because I know what everyone says is, well, if I'm a borrower and United Midwest is telling me, well, we're asking you to put in 20 and we'll give you a loan for 130. Why am I going to go cut a franchise fee check for 50 when I don't have to? I'd rather just see if I could pay a deposit. What is ideally that process for the franchisor? How should they look to structure that with taking a deposit and how that note should be set up? I just want to make sure people have a clear understanding of that.
Right now today for the franchisor, it should be a deposit, 15, 20, whatever they want down. And then from there, an accounts receivable. Stay away from notes receivables right now, because that's a big problem with SBA. And in essence, what we're having to do is have franchisors cancel those notes right here at closing and give us a canceled note and then give us an invoice for a receivable.
And I'm sure that creates a lot of fun in your department.
It's been a nightmare for the last month or so, but we're working through it. We're working through it.
Now you guys are the best. You're the best at this. That's without question. I'm going to go to the next slide, and I know we're not touching. I'm going to go back to the misperceptions and assumptions, but keeping in mind of where we're already going, since we're talking a lot about the loan. What does a candidate look like in this perspective? I mean, what is it that the banks? We talked about an equity injection that could be as low as 10%. We talked about that they don't need to have the personal collateral. So what does, in the eyes of, hey, if you want to see my underwriting department smile. This is what a candidate looks like. What does a typically ideal candidate look like for the 150 and under loan program?
Well, to start with, they've got to have good credit and to score in the Fair Isaac small business model. We've been using the Fair Isaac small business model since 2003, when we originally got involved with small loans under the Old Community Express program. About 4 or 5 years ago now, SBA adopted that same scoring model for all loans 350 and below. So all loans with SBA that are 350,000 and below get scored in the Fair Isaac small business scoring model. And that model is looking heavily at personal credit, but that's not the only thing it looks at. It looks at industry risk, time in business, startups go through a startup module. It looks at percentage of revolving available to the borrower. Is he maxed out on all his credit cards, or has he got some fallback room? How many people's actually pulled his credit in the last year, 2 years? Excessive credit inquiries will kill somebody scoring in that Fair Isaac small business model. So all those things go into there. What are we looking for above and beyond that? One, they have to have the liquidity to be able to put their 10% equity injection in. That has to be in their personal savings, checking, marketable securities, some IRAs, 401ks, even though IRAs and 401ks are not true current assets, we view them as such because it is money sitting out there they could get to if they had to. They may have to pay a penalty, but they could get to it. So they've got to have that on their own. Can a borrower get a gift? Yes, they can, as long as that gift is coming from the immediate family and we can document that gift. SBA requires we document that equity and where it came from. It can't be borrowed funds. The borrower can't go out and get a second mortgage on his house to put his equity in. It has to be funds that they have in savings, marketable securities, whatnot. We will allow gifts from immediate family members, but that's it. They can't get a gift from a close friend. That just doesn't fly. How many close friends are really going to give you 15, 20? That, you know, we weren't born yesterday, so we know better. And so does SBA. So that's kind of where that comes from. On the backside, we look for a borrower at the very least to have at least 50,000 in post-closing liquidity. After they put their 10% in and we get the loan funded, they've got at least another 50,000 sitting in savings, marketable securities, IRAs, 401ks, what have you, to go to in the case of a pinch. Let's face it, it's a startup. If the projections are a little bit off and they don't ramp up as quickly as they think, can they bail themselves out? Have they got some fallback to get to? And that's extremely important to us. If you're dealing with an existing franchise that's got a low default rate, and we look at the default rates on the franchisors, we go to the Coleman report, publishes a publication once a year, then it'll give you the default rates for the various franchises. If we're dealing with a franchise that's got a high default rate, then we're going to be looking for a lot more post-close liquidity. Or if you've got a brand new franchise that really doesn't have a track record yet, then we're going to be looking for a lot larger post-close liquidity. I just approved one this morning for a brand new franchise, just got put on the registry, but they have no track record whatsoever. So in that particular case, we said we want to look at borrowers right now that have post-close liquidity of at least 150,000 until we can establish some kind of track record that this franchise is a concept that's going to work well.
Wow, you just hit so many of like the hot topics that make up my world. I want to hit the pause button and go back over a few things. So you talked about the FICO score.
Right.
What is the minimum, I guess, for lack of better words?
675 and up is what I tell people to score in that model. The up depends on the risk of that franchise. If you're talking about a startup veterinary clinic, probably 675 or a little bit less will get you done. If you're talking about a startup restaurant, you probably need to be at 775 and up.
Yeah, I always like to tell people, if here's a good loan, anything that takes it down here, you've got to make up for it somewhere else. Like you said, so if we have an emerging brand or something else, having more post-closing liquid. And And as you can see, I have that bullet point: liquidity, 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 post-closing.
Exactly.
Number one, I think one of the biggest confusion is this is not money they're putting in the business. This is not money they're giving to the bank. This is Eric saying, after I make my equity injection, close on the loan, get into the business, this is my rainy day funds. This is my money that the bank needs to see that, to your point, while they're ramping up the business, that one, they're allowing that business to ramp up correctly and they're not pulling money out of that business before it can support it. Two, that I can continue to cover my debt service for a period of time and I'm not siphoning some of those loan proceeds to cover my own personal debt service. It's really just, we want to see that this person has money left over to allow them to operate this business as it was structured.
That's correct.
Okay. The other thing, and I'm sure you probably got tons of questions on this, and I don't know exactly the time that this happened, but, and I don't know if it was specifically you as the only lender, but in this program, there was a point where somebody said, we're looking for $50,000 in post-closing liquid. As the franchise world is the biggest game of telephone game ever created, and that message changes every person it gets to, I got 50 phone calls one day. Eric, I now heard the minimum equity injection that the bank is looking for is $50,000. So just for everyone to understand, it's not the equity injection that has to be $50,000. It could be that borrower injecting $10,000, $15,000, $20,000, but they need to have access in liquid, in marketable securities, checking, savings, retirement funds that meets or exceeds $50,000 or more. Am I on point there, Fred?
You're absolutely correct. That's exactly the way it is.
Okay. Now, does that post-closing liquid requirement change if, or how does all of this change based off of household income, employment, lack of employment, if both spouses are not working, if somebody is working, how does that play into the mix?
Well, once again, if they have no current income, if they're not maintaining a current job, then we're going to look, what's their household debt on a monthly basis? How much do they need to pay themselves out of that money that we're loaning them on a monthly basis as they ramp up, so that they keep their credit in good standing, so that they're not behind on their mortgage payment or their car payment or anything else. So that all kind of plays in there. Absolutely.
Yeah, I always tell people, listen, if there's still some sort of income coming in to support debt service, that $50,000 is still the minimum. Now, if somebody is out, it doesn't take them out of it, but I would just say you probably want to make yourself seem more liquid so that you show them, I don't have an income, but I still have the assets available to continue to support my personal living expenses and the debt service of the loan as we're ramping up this business.
That you're absolutely correct. That's exactly the way it is here. And that's what we're looking at. You know, if they don't have the ongoing income, what's it going to take to maintain their lifestyle for through the ramp up, and have they got ample funds in reserve to be able to handle that?
So I would not want to hold you to this and you say, Eric, I'm not really going to answer this one, but I apply for a loan today. I've got great fight. I've got everything, but I only have, after my equity injection, $30,000 in post-closing liquid. Safe to say that unless I get that gift that we're talking about, that likely lenders are not going to be interested in that loan application.
I can't speak for any other lender, but from our standpoint, no, we would not be. We would turn it down for lack of liquidity.
And can that post-closing liquid, to go to your point before, can that come from a gift?
Can it come from what?
A gift.
Yes, as long as it's immediate family.
Okay.
Once again, it all goes back to immediate family. Mom and dad want to give son $25,000 to get his equity into a deal or whatever, then yes, that's fine. But once again, we have to document their funds. We have to get copies of their bank statements for 90 days showing that they had that money. They weren't going out and borrowing.
And again, just so everyone understands on the line that's listening in today, you know, I think Fred mentioned the amount of volume that they're doing on a monthly basis. and the average loan size. So just do the math. That's a lot of volume. I'm not going to speak for Fred, but if I've got 80 packages right here where I'm not worrying about gifts, co-signing, marginal scores, and this, and on the other side of my desk are these ones that have all these things, we're all business owners. We're all trying to operate a good business. Where are things going to go? So I know the famous line in banking, hey, it all depends, but the more challenging somebody makes a package, you have to understand the bank is going to look at that. And when there's more clean deals there, for lack of better words, the marginal deals are going to have larger hurdles in getting there.
No question about it. At any given time right now, we've probably got about 350 to 370 loans in the pipeline at any given moment. So yeah, that's a huge pipeline we're working through. I think I'm up to around 30 employees now doing nothing but these small loans between packaging, underwriting, and funding. And we're constantly looking at ways to try to streamline it, but it is what it is. And SBA continues to request more and more information on these small loans. What used to be a credit score and fund it, no longer that way anymore.
It's a great transition to the next question. You mentioned about doing a loan for a brand new emerging franchise. So for those on the line that are less than 50 locations open, which in most of our industry, that's viewed as an emerging business. It's not that they can have candidates use this loan, but you're likely looking for a stronger borrower specifically on the liquidity side.
That's correct. That's correct.
Okay. And again, just because it seems to be a common question, for brands that don't have business assets as part of the brand, it's not that you won't do it. It's just that if they're available, you will request them. But if not, it's not that they can't do the loan and they're just not requiring to have the personal assets. It's not that where there's no business assets, well, now I have to get personal assets.
No, absolutely. Our typical candidate is operating from home, which is perfectly fine with us. And it's a service-based business. A prime example would be a Molly Maids franchise. Okay, what are they going to have? A couple of vacuum cleaners and some feather dusters. Nothing that a lender would typically be real excited about taking in a liquidation. But we're fine with that because we've learned over the years that if you properly capitalize that business, they can go out and generate sufficient income to pay us back. And that's the key to the whole thing.
So emerging brands, keep them coming. It's just a matter of they probably have to be looking for candidates that are not the, hey, I think this guy or gal can probably get to where they need to be. They probably need to be stronger in certain areas.
Correct. That's correct. The other hot point for us is when it comes to a borrower, if you've got a borrower that are getting involved in a franchise that's a technical in nature, requires a specific license, i.e. An electrical franchise, where he's going to go out and do electrical work for individuals or other companies. We're going to require that borrower, our borrower, be licensed in that field. We want to make sure he's a master electrician, not that he's going to go out and hire somebody to handle that for him. We want our borrower to be involved and maintain that license so that if things do go awry, that guy did leave him, he could run it on his own.
Perfect. Now, before I move off of liquidity while we're looking for good post-closing, I know this has been a bit of a moving target with the SBA, but because of the loan size and some borrowers that might be looking at this, I know what the answer is, but I'm going to ask it a certain way. Is there such thing as being overqualified for this loan, Fred?
Yeah, I mean, it's been on and off again with SBA. They put a rule in back about a year or so ago, and then rescinded it. The CARES Act rescinded it. But in essence, we do have to pay attention, and it's called credit elsewhere. Does that borrower have the means to in liquid assets? And I'm talking true liquid assets now. Cash, checking, savings, marketable securities. Not talking about retirement accounts because they're not a true liquid asset. does he have true liquid assets sufficient that he could fund himself and he doesn't need a government loan? And the general rule right now is if he's got more than 500,000 in personal true liquid assets, he probably can get credit elsewhere. He doesn't need the SBA's involvement.
Perfect. All right, now we're going to transition to.
And that kills me to have to say that, because I mean, I love the borrowers that can afford to pay me back, but
I love telling people, yes, you could be too qualified for something. We're now going to move into a very polarizing or very hot topic. Timelines. I know it's a very much of a moving point. It changes every now and then. And also people's understanding of what timing is. I love it when people say, well, Eric, they first spoke to you on this date and it's been this many days. I'm like, well, just because they spoke to us on this date doesn't mean they submitted a full SBA package. It's been here, there. Could you give us a quick idea or conversation around what is the timeline from start to finish? I'm an applicant. How do I start? What's the process it goes through? And from application to underwriting to closing to funding, where have you typically seen things? Can you talk through that a little bit?
Sure. The application approval actually is the same day we get that simple little loan application that we have out there, and they can get that at smallsba.com. We'll take them right to our landing page where it's a PDF fillable form. They can download it, fill it out, save it on their computer, and then hit the submit button, and it'll upload it to us. We load it into a platform that will pull their credit through Experian, communicate everything about them and their business and their credit out to Fair Isaac. It kicks back a score, and it's a pass-fail system. If you score above the cutoff that we have set in the model, we can approve it. At that point in time, we approve it. If it scores above the cutoff, we assign it to a packager who that same day or the following day will be in touch with that borrower, getting some basic information over the phone, and then she will, to complete a couple of forms, then she'll email that borrower a checklist of everything we're going to need to move that loan on down the pipeline, if you will, the assembly line. And it goes, once we get everything into that file that we need for SBA to dot the I's and cross the T's, then we can move it into underwriting. And the underwriters will pick that file up, review it for compliance with SBA, create the credit memo that SBA requires we put together, and that's the most time-consuming part of it. And then from there, they move it into closing, where the closers will pick that file up, finish up any documentation, usually getting insurance certificates and that sort of thing. Prepare the closing documents, and all the documents go to the borrower through DocuSign for electronics. Everything's electronic now. We don't keep paper. We don't even want paper anymore. Everything's electronic. And they sign them electronically, get them back to us. Once we get everything back, Terry or I review that file. Then it gets uploaded to the home office in Columbus, Ohio, and the wire actually comes out of the home office usually the following day or the next day, depending on what the closer and the borrower, how they've set it up to work. That's about start to finish is right now today a lot longer than I want it to be. It's about 60 days. For years we ran it about 30 days, but once COVID hit, a lot of the lenders that were doing small loans went away, and so we just got besieged with volume. And I've been hiring people as fast as we can and training them up. But we're at about a 60-day. That's starting to come down somewhat now as we get more and more people involved. And we're looking at some new closing doc prep systems that will help us speed that process up tremendously. But that's kind of where we are.
Yeah, and just so everyone that's listening, that 60-day timeline, keep in mind, the borrower is part of that timeline.
Yes.
So if a week goes by or another 10 days go by till they complete some of the checklist items, that 60 is now 70, the 70 is now 80, so on and so forth. So
we can move it as quickly as people will get information to us. And I still see deals that move through in 30 days or less. but that's not the general norm like it used to be. And you're exactly right. Getting the information out of the borrower is the biggest hurdle we face.
Next question on timing. Correct me if I'm wrong. Could I apply for a loan from United Midwest today and have not even signed my franchise agreement or paid my franchise fee?
No, not really, because we need the basic information to score it. We need to know what industry he's going to be in. The borrower needs to have formed their corporation or their LLC or their partnership or whatever they're going to be. We don't care. We just need that formal entity formed, and we need a tax ID number. They have to have that for us to move anywhere with it. So that
Now, if I still have those things in place, but maybe I just haven't formally closed with the franchise, is that still something? If I have the numbers from the FDD and everything else, I mean, it might not be ideal, but can you touch on that?
Yeah, we could get it started then. As long as they've got an entity set up with a tax ID number, then I can score it with SBA. And that's key. That's one of the first things we do. We don't pull down an SBA number until we're ready to move that loan into underwriting, because at that point in time, we've got all the required documentation in our file for SBA, and we pull down their SBA number at that point in time.
And I feel like we just covered a lot of this, but anything that you've seen from your perspective that puts the timeline on steroids and speeds things up? What have been some of the speed bumps that have slowed things down? Anything for franchisors just to keep in mind in their franchise sales process they should be cognizant of?
Borrowers that are ready to actually move and are motivated to get documentation into the lender as it's required, and not fight us, not try to tell us how to package their loan. We deal with SBA day in and day out. I'm the one that has to deal with SBA audits day in and day out. So I know what SBA is looking for. So give us what we need, give us what we ask for, and do it in a timely fashion so that we can move it as quickly as we can.
Now, it's a definitely a good rule of thumb. And what I would still say for a lot of the franchisors that are listening, listen, it doesn't have to be Benetrends, it could be anybody, but having relationships with funding partners, whether it be with banks, whether it be with any funding partner that's out there, they know what, as Fred just said, they know what Fred's team is looking for. So choose the path of least resistance. Have partnerships that you work with that know what they're looking for, and the partner can tell you up front, you need to have this, you need to have that, the candidate's going to meet this or meet that, so they can begin to work with the banks and have somebody facilitating that process. I mean, Fred, I wouldn't ask you to lock yourself into it, but safe to say a good lion's share of the packages you get are from all different types of funding partners or funding groups out there in the country, correct?
That's correct. We do a lot. We probably got 5 or 6 major players that we deal with that account for a lot of it. And we also do a lot of work with the small business development centers, which are SBA partners located with colleges and universities all over the country. But they can help borrowers put together projections and business plans and that sort of thing. And so
Great.
A lot with them.
Well, with a little over 10 minutes to go, I want to go back over some of the questions maybe we didn't get to, and then maybe just open it up for any others. But it seems like one of the more common ones we were getting is, we've talked about what this loan can be used for, what it can't be. And I saw a few questions is, what about in the terms of business acquisition, buying an existing franchise that is either it is brick and mortar, but it is under 150, or buying an existing that is not brick and mortar? Should this be the path that one goes down? And if so, how? Or to your point from earlier, should we really be looking at other lenders for those options?
Excellent question. We do not do any business acquisitions in our small loan program, and for a very simple reason. SBA will not allow us to just simply credit score a business acquisition. You have to do traditional underwriting, get the tax returns from the business, verify those through the IRS, spread the cash flows, come up with some true value for that business and go from there, which slows us down even further than what we are right now today. So until we get to a point where we can automate that historical cash flow spread with the tax returns and everything, We just don't do them. We stay away from them. We've got plenty of volume right now without going there and bogging our system down.
Absolutely. And how about if I am an existing business, I'm not looking for an acquisition, but I'm looking to get additional working capital for my business all day?
I love those all day long. And in that case, if the business has been up and running for more than a year, SBA says we do not have to document additional equity into the business. So if you've got an existing business, guy's been operating 3 or 4 years and he's just trying to grow, then we'll make him a $150,000 loan for general working capital to move into that new territory or to expand his marketing activities, that sort of thing.
Okay, great. Some other questions that I think come up every now and then, this is sometimes just in general with SBA. There are some business concepts where the employees within the business are essentially really employed by the franchisor. Sometimes you see this in the staffing business, and SBA has sort of not been able to do those. Still the case, obviously, right now, and with your program as well?
That's correct. That's correct. Typically those staffing franchises, if they're on the SBA or registry, then SBA's already looked at it and given us guidance on how we proceed with those loans. But if they're not on the franchise registry, we can't touch them.
Absolutely, absolutely. I guess final questions, specifically for this program. I hear quite often, and the reason we have Fred on today is because they do the best job from what I've seen in the lending space. And he's a tremendous asset to the lending industry and to franchising. But you hear a lot of people say, well, not a lot of banks do this. Is there a reason? Is it just loan sizes? I mean, you just said, hey, I've got 30, 40 people we're a volume submitting company. Is it because of that's just the way some people build it? Can you talk about that a little bit of why there's not 50 lenders to send a 150 and under loan package to today?
In a lot of cases, lenders just, where do they want to deploy their assets? Do you want to do $10,000, $100,000 loans, or do you want to do $1 million loan? And we as a company do both. And we've got a large loan division that typically will do deals 250, 300,000 and up, but they're pretty siloed in what they look at. They'll do business acquisitions, but primarily in the medical field and insurance agencies, acquisition, that sort of thing. Hotel motels, they'll do those kind of things. So it's strictly a matter of dollars and people.
No, it's people always say, well, somebody could do what Benetrends does on the back end. Why do we have 100 employees and somebody else has this, but they charge this and we charge that? Well, because we can handle that volume, and that's what we've chosen to focus our business on. Well, listen, before I let everybody go and let you get back to processing all those applications, any thoughts, take homes, certain things like that, or aha moments or things that you suggest for any of the brains or consultants that are on this? And just before I forget, because I've seen it a few times, I know Caitlin reminded everybody, yes, today's session is being recorded. So it'll absolutely be available through the IFA website and an email blast, and I'm sure I'll be sharing it on the Benetrends side as well. But Fred, any take-home comments before we wrap up?
Yeah, I'm sure everybody's aware we've been dealing with CARES Act funds now since February rather, and those funds are slated to run out the end of this month. September 30th is the fiscal year end for the SBA and for the CARES Act program. That program was giving a lender a 90% guarantee, but in addition to it waived the guarantee fees that a small loan borrower had to pay. And right now that guarantee fee would be, once these funds run out at the end of this month, it'll revert back to an 85% guarantee, and it would be a 2% guarantee fee. Well, SBA has already put out a notice that effective October 1, guarantee fees for small loans, 150 and below, will be waived again next year for the next year. So borrowers are not going to have to pay the 2% guarantee fee. That stays in place. The first 3 months of monthly payments being made by the SBA goes away with the end of the CARES Act here at the end of the month, but the guarantee fee waiver is still in place for all next year, which is a good thing.
That is a very, very good thing. Well, the last 2 or 3 questions or comments I would have is also in scenarios where, let's say I was doing brick and mortar, and the concept, the project size is over, 200, 300,000. If I wanted to fund the build out with my assets, but still get the 150 loan for my working capital, it's okay that I'm funding a smaller percentage of the project, but is that still something that is an option?
Yeah, as long as he's leasing that space and he's not buying it, then I wouldn't have a problem with it.
Okay, great. And just because we talked about liquidity and post-closing and the word IRA or retirement funds, just because we are sponsoring this call, I would like to remind everybody, obviously a great way to create liquidity where there might not be some is doing a rollover funding strategy. And that's with any of the tremendous funding providers that offer that. Obviously, Benetrends has been doing it for almost 40 years and is the primary funding source for a lot of franchisors when it comes to the rollover and assisting people with figuring out what to do in the SBA environment. Well, Fred, I cannot thank you enough. I know that I learned more in the last hour than I've done in the last 5 years as far as the 150 express, not express, fast track, whatever we want to call it. But I thank you so much for your time. I thank you for all the attendees. Any questions that I was not able to get to, please feel free to email me at eric@benetrends.com. I won't make you type in my long last name that Caitlin so eloquently said earlier at the beginning of the call. And I'm more than happy to either get the answer from Fred or from any other resource and help your candidates find out the options that they need. Fred, again, thank you so much. And everyone enjoy the rest of your day. And Caitlin, thank you for allowing us to host the webinar.
Yeah, thank you so much, Eric, and to Benetrends as well. And Fred, thank you so much again for joining us. Yes, as Ben said, this is recorded. If you have any issues accessing it on our community site, feel free to email webinars with an S, webinars@franchise.org. All right, Eric, Fred, thank you all again so much. Everybody have a great rest of your day. Thank you so much.
Thank you.